Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we have our EIA show. A lot of fun things to talk about given where things are. You know, we did have a draw, but we want to look at where is that draw in relation to normal seasonality? How is that seasonality impacting? We've had some decent builds in Europe. We've had some builds in some other areas, and we want to look at how is the global market really looking. So in segment one, we're going to look at how crude stocks fell in the US, but the distillate backdrop still remains very bullish, globally speaking, not just in the US. And then we want to look at how are things changing on the refining side, because there's a lot of different movements and different pieces when we look at the different crack spreads. Then we're going to turn to the US. Demand weakened again, but even with the weakening demand, distillate storage is still going to support cracks. We're still in a tough spot as we head into the winter months, and that's something that we want to dig into further. And then lastly, we're going to look at crude exports. And crude exports have fallen, but at the same time, you've seen a big increase in refined product exports. And we want to look at how is that offsetting? Is it one for one? Is there more flow to come, especially as we prepare for the new Chinese export quotas that are supposed to hit either this week or next week. Now that's when we jump into what is happening around the world, especially when you're starting to look at crude, refined products, all these different pieces. And here you can see that total oil and product stockpiles, the surplus widened from 56.4 to 56.8, small increase, but this is what we've been saying, is that it's going to go sideways. There's going to be offsetting pieces. So yes, the US had a draw, but Europe had a build. We've seen some build in some other areas. So there's some of these offsetting pieces when you start looking at everything put together. And the same can be said when you look at total crude stocks, land and floating, where the surplus widened from 53.1 to 60.8. So even as the U.S. has come down a bit, you're still getting some builds in Europe. Refined activity continues to be slower because of weather, because of slower demand on a gasoline side. And that's when you can see that on a seasonally adjusted basis, we're actually breaching where we should be, because typically we should be declining. We should be having steady draws at this point, and we're just not getting that. And instead, we're just staying at this elevated level. And next week, just based on the leading indicators that we're seeing, we're going to break out into and be above what is that gray cloud there. So again, even as the surplus could come down, you're still at a very elevated level from a crude perspective. Total oil product stockpiles flipped to deficit from positive 3.3 to negative 3.9. But you can see we're hugging this average. And the problem is that the disconnect between the two, because we have a significant amount of heavy resid and light distillate, but we don't have a lot of middle. And that's where it's like, it looks like we should be okay, but when you break it into its pieces, we're really in a problematic spot when you look at the middle distillate side, and a lot of that is really driven based on the lack of heavy and medium, which is creating some of those issues, which is what some of these countries are trying to take advantage of when you look at what they're currently exporting. And if it sounds like I have a bit of a lisp, I cut my tongue, so it's impacting it just slightly. So total land storage, the deficit narrowed from 7.4 to 3.8. Again, it's what we've been saying is, instead of getting this draw, the comps are going to get easier. And this crude level is going to stay at a fairly steady pace, especially when you look at a global basis, because I know that obviously it's EIA day, so everybody wants to look at the U.S., but it's not just the U.S. that matters. There's a lot of pieces that fall within that, which we really have to look at when we're talking about some of the different levels and some of the different pressure points that are going to continue to be in this case. Land storage west of Suez, deficit narrowed from 8.5 to 1.7. And a lot of that is driven by not only just the builds in the U.S. 2 weeks ago, but also in Europe, which is continuing to build here, which we're going to continue to see go up. Now, the U.S. drew, so you're still going to get a little bit of a move down in that seasonality. But again, you're seeing some of that elevated pieces kind of hold in at this point. East of Suez, weekly draw, the flip to deficit, it went from a positive 1.1 to a negative 2.1. But you can see here that it's just, the this is the just looking at Japan. When you factor in China, when you factor in where things are on these levels, you're still seeing this elevated piece. And that's really where we're seeing some of the problems is when you look at east of Suez versus west of Suez on the land storage side, where you're continuing to see that move up. And it's interesting because now, and we'll talk about this in segment 3, you have a lot of Chinese refining capacity that is ramping up. You're seeing a lot of additional activity, and that is helping to push things a bit higher. So now when you look at total floating storage, the surplus now are from 48 to 39.6, but you can still see we're going back to 2016. We're still at all-time highs. West of Suez flipped the deficit from 5.3 to negative 0.2. A lot of that is just driven based on Europe. West Africa still remains elevated, but is drawing down a bit. But you're still seeing it's coming back to that level, while east of Suez, the surplus now from 24.2 to 20.3, but we do see a little bit, not so much a pivot higher, but just hugging the highs, hugging this upper level, while we do see west of Suez, getting a bit more quote unquote normal. We do see a bit of this elevated piece remaining in the east of Suez. When you look at the adjustment factor, because people like to focus on it, here you can see it's gone up a bit, but again, it's that back and forth with the export side. So nothing too meaningful at this point in time, but just so where everyone's aware, it does trend higher as we go through the month, and then it corrects as we get into the end of the month, beginning of next month. So crude stocks drew. We had a draw of 5.96 million. SPR had a small build. So the total draw was 5.36. But again, as we talked about, SPR was going to build ever so slightly. The draw was driven by Pad 2, which had a drop of 1.54, Cushing 840,000, and then Pad 3 of 4.93 million. As we were saying, Cushing typically starts to flatline, so the pace of draws slows. We're going to look at how that sets up. Even with Pad 3 having a sizable draw, we're still 3.4 million over the 5-year, 8.7 million over the year-over-year. And then Pad 2 had some waffling back and forth with imports, with a big drop in Pad 2 imports. Again, that's more of that kind of lumpiness when you look at different flows. Crude oil production, it has us at 12.7. That's wrong. It should be lower. But again, that's just something that it will adjust over that time period. So now when we look at crude oil inventories going through here, you can see we're right at where we were in 2021, 2019. The only 3 years higher was 2017, 2016, 2020. So again, it's just fairly normal, and as you can see, it typically, trends down. So the question is going to be, what is the pace of the exports? What are the pace of our draws? And realistically, we see them, essentially mirroring where things are, and then they'll flatline and then start to have those normal builds. Total U.S. commercial oil storage and products, it's right at where it was in 2018, above where it was in 2022. But again, a lot of this is being driven based on distillate, not on gasoline, not on crude, which again is going to be supportive of that distillate crack. So then when we start looking at crude oil inventories in Pad 3, here you can see that the only time it was higher was 2016, 2020. So even with these draws, you're still very elevated. It's right at where it was in 2021. More than enough opportunity for exports, especially given our products that are continuing to flow into both Asia as well as Europe. When we look at storage and Cushing, as we were saying, it was going to start to flatline. Here, we're just tracking right where we were in 2021, right at that average. It should continue to flatline here. It's really going to be driven on how quickly do we pull down those Pad 2 imports. We did have that slowdown, which weighed just ever so slightly, which is going to be an important thing to watch going forward. Runs, as we were saying, it's going to increase to get to about 94.5, 95.5%. So nothing here, an increase of 90 basis points to 94.7. Pad 3 slowed down a bit. That there could be a bit more headwinds in Pad 3 because of the heat that's coming through. But again, that's going to be something that'll watch, that are going to be important to watch. And then we are getting deeper into hurricane season, which matters more when you look at August, when you look at September. So when it's going to be an important thing to watch. So far, the storms that are showing are very low probability, so nothing too crazy at the moment. But we do see pad 3 rising a bit, getting us to that 95%, 95.5%. Utilization rates, when you look at utilization rates coming in at 94.7, as you can see, very seasonally speaking, it's normal, but it'll be, we'll keep tracking that in general. Imports increased 475,000 barrels a day. It was really driven by pad 5, which, as we said, was too low before, very lumpy. Here's your increase. Pad 3 had that small increase of 150,000 barrels a day. It's going to be balanced between that 1.35, 1.55, and kind of work within that level as we import those. It's the heavier barrels, but remember, Pad 2, big drop of 331,000 barrels here. That is, we will get a makeup number on that, so we will get a bounce. And then Pad 1 had that big increase last week, so here's that decline. So again, nothing too crazy in terms of flows. Pad 3, as we've been saying, below the 5-year average, staying, but closer to the 5-year at higher, but still below the 5-year, just in that cloud as we continue to see different flows. Pad 2 had that drop, but as we've been saying, it's still going to bounce back up. We're still going to stay above that 5-year average just because of the benefits coming down from Canada. Implied demand, gasoline had that drop to 8.85 million from 9.3. The drop is too far, but again, it's just 9.3 was too high. And that's what we've been saying, is it's that balancing act, and it's still coming in very low. It's still well above where we should be for this time of year. And then distillate had a drop as that normalization of 114,000 barrels a day. Nothing too crazy. Jet fuel fell back within our window, 1.55, 1.65. Not too much there, as propane started to get a little bit of love with an increase of 441,000 barrels a day. But that's something that will trend up and down a bit because of the heat. And obviously with the heat remaining, that's because some of this is used for cooling, so that's going to keep some of that demand in there. But we're past core gasoline driving season, so again, the trend's going to be down. They'll probably get a little bit of a bounce. We do have a little bit left, and then obviously Labor Day, you get that nice bounce. But distillate is going to stay here, very lackluster, as we'll talk about in segment 2. U.S. gasoline implied demand, you can see here, we're right where we were in 2020. We're below where we were in 2022. And we're just going to continue to kind of bounce around these low levels and really not get back to where we should have been, as we've been talking about the pressure on demand. Days of supply for crude, very normal, nothing too concerning one way or the other. Gasoline storage, as we were saying, flatlining. Typically, you get an acceleration to the downside of draws, and we just don't see that given where imports are, where demand is, where production of gasoline is. And here you can see it's now sitting where we were in 2022, and we thought it was going to kind of bounce up, come back down. Instead, it's just held steady. And as we progress through August and into September, the comps get easier. And as the comps get easier, that's where we'll fall closer to where we have been historically, and not being the same as you get these headlines as like, oh, lowest ever, or lowest in how many months or years. It's like, guys, look at it. It's just flatlining, and all of the other draws from those other comp years are coming to meet us, not the other way around. And so now when you look at distillate, there was a small build, but you can still see it's very low. We are not where we need to be as we're starting to prepare to go into heating season, into that point in time, which is why we do see those concerns. Jet holding right around the 29-year average, not too much up or down. When we look at crude, futures here, you can see still remaining elevated, still in backwardation. Interest rates moving up, where demand based on where it is. We've had some softness, some movement down in physical barrel pricing, but it's still stronger than it was prior to the Saudi announcement of the increase in extension of the cut. So again, it's just, we're going to continue to be at these levels, continue to be in this backwardation at this point in time. Floating storage came down just a bit, so again, some of that timing delay, we did get that drawdown. We will see some support in that imports into pad 3. So again, not too much of an adjustment there. We do see some additional barrels coming from West Africa that will help replenish some of the floating storage as we see some of that continuing to draw down a bit. And that's something that we'll talk about more in segment 3.